Oil prices are climbing as the war with Iran escalates. This week alone, crude had its biggest weekly gain in the history of the futures contract dating back to 1983.
Yeah, barrels of crude are trading at $90 as of 4 o'clock. Across the U.S., gas has jumped more than 32 cents in the last week. Here in Texas, it's sitting at $2.98. Yesterday, it was 11 cents less. And this time last week, before the strike started, we were sitting at an average of $2.60 a gallon.
All right, joining us now, our energy expert, Ed Hers. Ed, how exactly does this conflict with Iran end up with these gas prices here?
Everybody's counting on Iranian oil not getting to market. And so for a 1% decline in quantity getting to the market, the price goes up 25%. That's the price elasticity of demand for oil. The real fear is with the Strait of Hormuz at least partially blocked right now. If that strait, say, only half of that gets through, the price will go up well north of $150 a barrel. That's the challenge. And you know, the president has always been all about low oil prices, low fuel prices. So I don't think the market expects this to last for much longer, but if it does, then we're going to see some real pain at the pump. We'll see gasoline prices above $5 a gallon.
Well, Ed, we've seen that now more than 30 cents in a week. I mean, that's a lot. I mean, this is a short-term spike. I mean, is it going to stick around for a while, or could we see it jump even more by next week?
If the strait continues to be blocked, that's taking 18 to 20 million barrels a day off of the market. There's no way to replace that from either our strategic petroleum reserve or China's. You know, the market just doesn't have enough spare capacity to get through that choke point. Remember, during the pandemic, the price actually went to zero or negative on one day. If folks are 1 gallon short of getting to work, they're willing to spend $10, $20 a gallon to get to work. And so that's what drives the price up. What we're able to do with the oil, what we're able to do with the gasoline and the diesel.
Well, Ed, as you know, the U.S. produces a lot of oil. Why doesn't that protect us from price spikes like this?
Our market is open, and so we can export and import oil all day long. You know, the great thing is because of our production, we're not going to run short. We're not going to have gasoline lines. We get 4 million barrels a day from our Canadian allies who ship it, some of it straight to the Gulf Coast for refining. But because our markets are open, anybody in Tokyo who needs fuel can buy it from the U.S. And you know, to be fair, a Texas oil man's not going to undercut his price by giving it away.
Is there anything the government can do right now, the U.S. government, to protect the consumers for rising prices?
Not really. A quick end to this war, peace breaking out, a free flow of oil and transit through the Strait of Hormuz would do the most to calm energy markets. Keep in mind that the natural gas market, the LNG market globally, has been upset by the attacks on Qatar. Qatar has cut off its LNG exports. That's almost 20% of the global supply. That's had a real impact on diesel prices globally because a lot of nations have switched to diesel off that LNG. And New England has got a real problem with natural gas and electricity prices because they import LNG from the global market.
All right. Well, let's hope things improve because we don't like
bad.
paying more. All right. Thank you so much, Ed Hers, our energy expert. Moving on.